Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Master Bond Laddering for a Balanced Investment Portfolio. Common mistakes in bond laddering. Implementing bond laddering can seem straightforward, but even seasoned investors can stumble. Navigating this strategy involves awareness and precision. As you build your bond ladder, steering clear of common pitfalls is crucial for maximizing benefits and minimizing risks. Overconcentration in certain bonds. Placing too many eggs in one basket is a classic mistake. In bond laddering, this translates to an overconcentration in specific bonds. While certain bond types might tempt with higher yields, focusing heavily on them elevates your risk exposure. Consider this. If a significant portion of your bond ladder consists of corporate bonds and a sector downturn hits, your portfolio's stability could be at stake. To mitigate this, diversify across bond types. Government, municipal, and corporate bonds should all find a place in your ladder. A well-balanced bond mix safeguards against specific market fluctuations, acting much like a well-rounded diet balances nutrition. By having this variety, you're less likely to suffer from the ups and downs specific to one type of bond or sector. Ignoring inflation risk. Inflation can quietly erode your bond ladder's real returns. Think of inflation as a slow leak in your financial tire. If not regularly checked, your investment could deflate over time. When inflation rises, the purchasing power of your bond's returns diminishes, potentially turning what seemed like a healthy yield into a paltry gain. To combat this, keep your eye on inflation trends and adjust your ladder accordingly. Consider including some inflation-protected securities, like Treasury inflation-protected securities, TIPS, as they offer a hedge against inflation's impact. By regularly revisiting and recalibrating your ladder, just as you would a thermostat for changing temperatures, you ensure your investment remains aligned with its real return objectives. In essence, avoiding common mistakes in bond laddering requires diligence and strategic foresight. By diversifying your bond types and addressing inflation, you set up your ladder for long-term success. Alternative strategies to bond laddering. When it comes to managing a bond portfolio, there are alternative strategies to consider beyond the tried and true method of bond laddering. Diversifying your investment approach can lead to new opportunities and potentially enhance your returns. In this section, we'll explore two popular strategies, the bond barbell strategy and investing in bond mutual funds and ETFs. These options offer different benefits and risks, allowing you to tailor your investment strategy to your personal goals. Bond barbell strategy. The bond barbell strategy is like having a lighter weight at each end of a balance scale. This strategy involves investing in both short-term and long-term bonds, with little to no allocation in intermediate-term bonds. The short-term bonds offer liquidity and lower risk, while the long-term bonds aim to capture higher yields. It's a way to balance safety and potential profit. How it works. Picture yourself at the gym, one set of heavy weights, long-term bonds, on one side of the barbell, and lighter weights, short-term bonds, on the other. This setup helps manage interest rate risk by positioning your portfolio to benefit from both ends of the maturity spectrum. Short-term bonds give you quick access to cash, while higher returns from long-term bonds are possible. Contrast with laddering. Unlike bond laddering, which spreads investment across multiple maturities evenly, the barbell strategy focuses on extremes. It doesn't require reinvesting at regular intervals, but instead relies on strategic adjustments based on market conditions. While a ladder provides steady income, the barbell might offer more flexibility with interest rate changes, akin to having a foot in two camps. Bond mutual funds and ETFs. Bond mutual funds and ETFs present another route for those wary of managing individual bonds. These funds pool together bonds and are managed by professionals. They can be a hassle-free alternative, providing diversification without the need to buy numerous individual bonds. Pros. Diversification. By holding a variety of bonds, these funds spread risk across different issuers and maturities, like buying a mixed bag of assorted chocolates instead of just dark or milk. This can protect against the underperformance of a single bond or sector. Liquidity. Funds can be bought and sold easily, with ETFs traded throughout the day, much like stocks. This feature adds an element of convenience, offering investors easy access to their capital. Cons. Fees. Management fees are attached, which can eat into returns. Think of it as paying for convenience, like grabbing a pre-packaged salad instead of chopping your own veggies. Over time, these costs can add up. Market risk. Unlike individual bonds held to maturity, bond funds don't guarantee the return of your initial investment. They're subject to market price fluctuations, leading to potential losses if sold during downturns. Choosing between these strategies depends on your risk tolerance, need for liquidity, and investment goals. Understanding the nuances of each can help you make informed decisions that align with your financial objectives. Final thoughts on bond laddering. Stepping into the realm of bond laddering can be like learning a new dance. It's tricky at first, but rewarding once you get the hang of it. This strategy offers a balanced blend of income generation and risk management, making it a favorite among savvy investors. Let's wrap up the essential takeaways. Key advantages to remember. At its core, bond laddering is about spreading risk and ensuring liquidity. By staggering bond maturities, you create a dynamic portfolio that adapts to changing market conditions. Imagine having multiple safety nets that catch you no matter where you fall. Predictable income. With bonds maturing at different times, you receive regular interest payments, much like a financial metronome keeping your investment beat steady. Interest rate buffer. If rates rise, you can capitalize on higher returns with reinvestments. If they fall, your earlier higher yield bonds still cushion the impact. Flexibility. Regular intervals for bond maturation mean you can access cash when needed, almost like having an ATM that dispenses funds without the usual withdrawal fees. A strategy worth considering. Why should you consider bond laddering as part of your investment toolkit? It's tailored for those who value stability without sacrificing growth potential. Think of it like a reliable friend who's always got your back, no matter the economic weather. Who benefits? Whether you're a retiree needing steady income or just someone who hates surprises, bond laddering suits you. It's user-friendly and scalable, fitting portfolios of all sizes. Implementation. Start small if you're cautious. Test the waters by building a simple ladder with a few rungs, then expand as you grow more comfortable. It's like training wheels for investors, you gain confidence with every step. Your next move. So, will you take the plunge into bond laddering? As with any investment, it requires attention and care, but the potential payoff, both in peace of mind and financial security, is significant. Consider this strategy as part of your broader investment approach and watch how it steadies your financial rhythm. Remember, a well-constructed bond ladder is more than just a strategy, it's a commitment to a balanced investment journey. What will your next step be? Conclusion. Bond laddering is a smart tool in any investor's kit. It balances stability and growth opportunities, adapting to different market conditions. Whether you're seeking a stable income or a buffer against interest rate changes, bond laddering hits the mark. Each bond maturity is like a checkpoint for your financial goals, offering both predictability and flexibility. So, is bond laddering the missing piece in your investment puzzle? Consider adding this strategy to your portfolio mix. It's not just about buying bonds, it's about structuring them to work for you. Start small if you're new, and grow as you become more comfortable. We'd love to hear from you. Have you tried bond laddering, or are you thinking about it? Share your experiences or drop any questions in the comments below. Let's keep the conversation going. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.